Hi there, it's Friday the 29th of May 2020. I'm Steve Towers. Welcome to ITB. Let's get started. Pascal Santaman has made some interesting comments in regard to the status of the digitalisation project. In regard to Pillar 1, he said that there are difficult discussions occurring in regard to two issues. Firstly, whether Pillar 1 can or should be limited to digital companies. You'll remember that the OECD's mantra is no ring fencing. And secondly, whether the US proposal for Pillar 1 to be a safe harbour should be adopted. But in regard to Pillar 2, the global minimum tax, he indicated that there was little disagreement in the inclusive framework. He said that only China and tax havens have concerns with Pillar 2. And he commented that there is a fair chance to see something very significant on Pillar 2 in the October plenary meeting of the inclusive framework, provided that countries agree to grandfather the US guilty rules, which is expected. The Tax Foundation has issued two interesting reports on digital taxation. The first report is called Digital Services Taxes. Do they comply with international tax, trade and EU law? The report focuses on France's DST and it considers potential challenges under double tax treaties, WTO and bilateral trade agreements, and the EU's VAT directive, freedom of establishment and state aid rules. And the second report is called Digital Taxation Around the World. This report reviews various digital tax policies which have been implemented in OECD and some other countries. It identifies 5 types of digital tax policies, which I've set out here. For a copy of these two reports, please go to our website or app. In Australia, the tax authorities have issued a taxpayer alert which describes their concerns with certain cross-border transactions which mischaracterise arrangements for inbound investment into Australia. According to the alert, these arrangements mischaracterise the structure used by foreign investors to invest directly into Australian businesses. They typically display one or more of 4 features. I've set out the 4 features here. Please hit the pause button to study this list. The alert gives 2 examples of these arrangements. Let me take you through them. In the first example, an Australian resident company raises capital from an offshore third-party investor. The investment is ostensibly made in the form of debt finance, and the return payable by the Australian company is calculated at interest rates exceeding those obtainable from traditional debt investors. There is a contingent additional return payable to the third-party investor in the event the Australian company disposes of its assets, with the amount of the return reflecting a share of the disposal proceeds. The contingent additional return is treated as not subject to Australian withholding tax and not otherwise subject to Australian tax. Payment of interest may be deferred until the Australian company sells its assets. The Australian company treats its Australian taxable profit on sale of its assets as reduced by the amount payable to the third-party investor, either in the computation of the capital gain or by deduction of the amount from the company's assessable income. According to the alert, one particular concern with this arrangement is whether it is appropriately characterised as debt for various Australian tax purposes. In the second example, an Australian resident company which holds a mining right raises capital from the US subsidiary of an offshore third-party investor. The US subsidiary provides capital funding to the Australian company in the form of acquisition of a newly created right to receive payments calculated as a percentage of gross revenue from the disposal of natural resources. The US subsidiary is used in order to take advantage of the Australia-US Treaty. The US subsidiary does not, in terms, obtain a legal interest in the Australian company's mining right. The return payable to the US subsidiary is treated as not subject to Australian income tax or withholding tax. The alert identifies a number of concerns with such arrangements, including, is there a breach of Australia's GAR? Are the conditions for treaty benefits not satisfied? Are the arrangements mischaracterised as debt? Is a taxable capital gain triggered? And do the arrangements comply with the arm's length principle? For a copy of the alert, please go to our website or app. In China, the government has announced that it intends to provide additional savings of 2.5 trillion yuan, which is about 350 billion US dollars, for enterprises throughout 2020, including further tax and fee cuts of about 500 billion yuan, which is about 70 billion US dollars. These comments were made during Premier Lee's address to the National People's Congress. For a copy of his paper, please go to our website or app. In India, the government has issued new rules on the amount of fund management fees for offshore funds to qualify for the benefits under Section 9A of the Income Tax Act. For a copy of the rules, please go to our website or app. In Malaysia, the tax authorities have issued guidance on the application of subsections 12.3 and 12.4 in regard to a person's place of business. These two provisions were introduced with effect from the 28th of December 2018 to deem income to be derived from a Malaysian source. The provisions are particularly relevant for companies which are resident in jurisdictions which do not have comprehensive double tax treaties with Malaysia. For a copy of the guidance, please go to our website or app. Also in Malaysia, the tax authorities have issued guidance on the tax treatment for financial institutions in regard to the loan moratorium provided to their customers. For a copy of the guidance, please go to our website or app. In last week's ITB, I mentioned that a bill to impose VAT on inbound digital services has been introduced into the Philippines Congress. The bill will also make network orchestrators, such as Grab, that link customers and providers withholding agents for income taxes, and make network orchestrators for lease services such as Airbnb and electronic platforms such as Lazada withholding agents for VAT. For a copy of the bill, please go to our website or app. In Singapore, the tax authorities have issued updated guidance on the income tax treatment of REITs. The updated guidance in particular considers the impact of COVID-19 and reflects the government's announcement of measures to assist listed REITs with cash flow challenges. For a copy of the updated guidance, please go to our website or app. In Austria, the tax authorities have issued guidance on the impact of COVID-19 on double tax treaties. You'll remember that the OECD and some other countries have issued similar guidance. For a copy of the Austrian guidance, please go to our website or app. In Denmark, the tax board has decided another case concerning whether an employee's home office causes the employer to have a PE. You'll remember that I covered 2 cases on this same topic in ITB late last year. In this present case, the issue arose under the Denmark-Germany Treaty, which has the same PE definition as in the 2014 OECD Model Treaty. Here is the relevant structure. Exco is a company resident in Germany. Exco carries on an online business of selling spare parts and accessories. Exco has an employee who is resident in Denmark. The employment contract has a duration of 6 months. The employee spends 3 days each month in Germany, but for the remainder of the month, the employee works from his private residence in Denmark. Exco does not provide the employee with an office outside of his private residence. The employee's role includes these activities: develop the business in Denmark, website building, conduct marketing activities, investigate customer needs, and preliminary negotiation of sales contracts, but the role does not include the conclusion of sales contracts. The board held that the employee's private residence did constitute a PE for Exco in Denmark. Importantly, the board decided that the employee's activities did not fall within the preparatory or auxiliary character exception in Article 5. For a copy of this case, please go to our website or app. The European Court of Justice has decided a VAT case in regard to the impact of price reductions which were obtained after the taxpayer calculated its input tax credits. The court held that the tax authorities were permitted to reduce the input tax credits. For a copy of the case, please go to our website or app. The European Commission has released an EU budget plan for the economic recovery from COVID-19. The plan includes several possible sources of additional revenue for the EU, which I have set out here. The fourth of these items, additional company tax, is interesting. The plan says this: companies which draw huge benefits from the EU single market and will survive the crisis, also thanks to direct and indirect EU and national support, could contribute to rebuilding it in the recovery phase. This could include an own resource based on operations of enterprises which, depending on its design, could yield around 10 billion euros annually. Commentators have speculated that this item is possibly referring to the common consolidated corporate tax base, or even possibly the introduction of an EU tax of 0.1% on the gross revenues of large companies. For a copy of the plan and a 3-page fact sheet on financing, please go to our website or app. In Finland, the tax authorities have issued guidance on the exit tax rules for companies. Those rules transpose the exit tax rules in ATAD 1 and are effective from the 1st of January this year. For a copy of the guidance, please go to our website or app. In Greece, the tax authorities have issued guidance in regard to the availability of VAT input tax credits for holding companies which are also engaged in economic activities. For a copy of the guidance, please go to our website or app. Also in Greece, the government has announced that the deduction for qualifying R&D expenditure will be increased from 130% to 200% for expenditure incurred on or after the 1st of September 2020. In Norway, the Tax Appeals Board has decided a case in regard to whether Norway's former interest expense limitation breached the EEA's freedom of establishment. The board decided that there was no breach for two reasons. Firstly, the interest expense limitation was not a restriction on the freedom of establishment. And secondly, even if it were such a restriction, it was a justified and proportionate means to protect Norway's tax base. For a copy of this case, please go to our website or app. In Turkey, the government has increased the rate of banking and insurance transaction tax on foreign exchange sales from 0.2% to 1%, effective the 24th of May. For a copy of the presidential decision which made this change, please go to our website or app. In Ukraine, legislation has been enacted which, inter alia, will introduce several changes inspired by the BEPS project, which I've set out here. For a copy of the legislation, please go to our website or app. In Algeria, the tax authorities have issued guidance on the changes to withholding tax on outbound fees for the use of computer software, which were made in the 2020 Finance Act, effective from the 1st of January this year. Prior to the change, the fees were reduced by 80%, and then the balance of 20% was subject to a tax rate of 24%. Which gave an effective withholding tax rate of 4.8%. Under the change, the fees are now reduced by 30%, with the balance of 70% being subject to the 24% tax rate, which leads to an effective withholding tax rate of 16.8%. For a copy of the guidance, please go to our website or app. In Kenya, the Court of Appeal has decided an interesting case in regard to withholding tax on commissions paid to non-resident sales agents. The taxpayer is a Kenyan resident company which makes export sales of macadamia and cashew nuts. The sales are facilitated by several non-resident sales agents acting on behalf of the taxpayer. The taxpayer is contractually obliged to pay sales commissions to the agents, on which a Kenyan withholding tax is levied. However, a practical problem arose. The agents received the gross sales proceeds from the customers, then deducted their sales expenses and commission, and remitted the net amount to the taxpayer. And so the taxpayer did not make any payments to the agents. The taxpayer therefore argued that it was not liable to collect withholding tax because it did not make any payments from which it could withhold the tax. The court rejected that argument. It said that provision ought to have been made in the contract between the taxpayer company and the foreign agents to ensure that at the point the commission was paid, withholding tax should have been factored in and thereafter remitted to the taxpayer company. In both Chile and Mexico, the VAT on inbound digital services will begin next Monday, the 1st of June. However, the government in Paraguay has announced that it will defer the introduction of VAT on inbound digital services for 6 months, from the 1st of July 2020 to the 1st of January 2021. I have 3 articles for you this week. The first article is called Insurance of Tax Risks, the Current State of Play in Asia. It's written by Martin DeLange and Aris Wong, and it's published in the IBFD's Asia Pacific Tax Bulletin. This is an interesting article for international tax advisors. It describes, each with several examples, 2 types of tax risk insurance which are relevant to Asia Pacific. The first type is called Warranties and Indemnities, W&I insurance. The authors write this: W&I insurance transfers transactional risks to an insurer in a transparent and cost-efficient manner by compensating the insured, either the buyer or seller in an M&A transaction, for financial loss from a breach of warranties given by the seller or a claim against any general indemnity for unknown matters. W&I insurance does not cover known matters, including specific indemnities given due to known issues flagged in due diligence, as these risks could be allocated between the parties by way of an adjustment to the purchase price or otherwise. W&I insurance provides certainty to the parties by placing a price tag on unknown risks that only crystallise post-completion, hence facilitating the negotiation and conclusion of a transaction. And the second type is simply called tax insurance. W&I insurance only provides cover for unknown tax risks, while we see an increase in demand for coverage of known risks. Tax insurance was developed to meet this demand and has now evolved to cover not only known transactional M&A risks, but also non-transactional risks such as corporate reorganisations. Tax insurance provides coverage for an identified risk of a loss arising from a successful challenge by a tax authority to the expected tax treatment of a proposed or historic transaction. In addition, it also covers associated defence costs, interest, non-criminal penalties and fines, and gross up for payments made under the tax insurance policy. The second article is called Influencer Income and Tax Treaties. It's written by Savas Kostakidis and it's published in the IBFD's Bulletin for International Taxation. This article considers the treaty categorization of the income earned by influencers on social media platforms, and in particular Articles 7, 12 and 17. The author concludes in this way: influencers realise several categories of income that must be assessed separately when it comes to their classification for the purposes of the OECD Model Treaty. Primarily, they gain advertising income which falls under Article 17, provided that their posts have an entertaining effect on the public. According to sponsorship agreements, influencers are paid to wear clothes or carry equipment, etc. during events. This income also falls within the ambit of Article 17. Again, the character of the performance of the influencer must be entertaining so that a case-by-case analysis is necessary. The use of or the right to use images and or name rights fall under Articles 7 and 12, depending on whether the image and or the name rights are legally protected as trademarks in the source state. Only in those rare cases where a close connection with a performance can be identified will the income accruing therefrom fall within Article 17. Finally, merchandising income falls under Article 17 only when it is closely related to a specific performance. In other circumstances, merchandising income falls under Articles 7 and 12. The third article is called Taxation of Capital Gains on Indirect Sales of Shares of Brazilian Companies by Non-Residents, the Allocation of Taxing Rights or Tax Avoidance Schemes. It's written by Isabel Fonseca and it's published in the IBFD's Bulletin for International Taxation. According to the author, the subject of this article was chosen because given the numerous transactions involving foreign investment funds that require the acquisition of control of a Brazilian company through a vehicle abroad, it is a current issue. This tax model, which often applies under foreign law, must be evaluated carefully from the perspective of Brazilian law and administrative jurisprudence. And when she does, she concludes that Brazil needs new legislation on this topic. In the author's opinion, the ideal situation in Brazil would be to enact new legislation that contains a clear provision for taxation of the indirect sale of shares by non-residents together with a specific anti-avoidance rule. Such a situation arises as it is not only necessary to enact a law that grants to the source state the right to tax in these circumstances, but also to include a rule to curb anti-avoidance schemes. With regard to the new legislation, the challenge would be to define a Brazilian asset, that is, the element of connection with the source state that would give rise to taxation in the country, as well as the exceptions to its application. Well, that's the way it is this Friday, the 29th of May, 2020. The ITB team will be having a well-earned one-week break. We'll be back full of life on Friday, the 12th of June. Until then, I'm Steve Towers. Have a great weekend.